Hello, everybody. Welcome to the webinar. I just want to let anyone know who's been on the webinar in the last few days. We will be going through the slides as the last two presentations, as there have been no updated changes in the program. So we aren't sharing anything new today. I just want to give everyone the courtesy of letting you know that. Welcome to our program about understanding the Main Street Lending Program under the theme of Funding Forward. Please post your questions in the Q&A only. The moderator will get through them all at the end of the slides. A recording of this webinar and slides will be posted shortly on our community site at realtime.inc.com. And later in this day, we will also be emailing a copy to participants. A little bit about myself. I am the founder and CEO of Multifunding. I'm an Inc. columnist. I've advised prior administrations on the small business lending markets. I have a book out called The Growth Dilemma. And for my EO friends out there, I'm a proud EO board member of EO Philadelphia. My lawyers asked me to share some disclaimers. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time about the program. And however, key questions remain about how to implement it. Multifunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future. And we are under no legal duty to update any such information or recommendations. And we encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. Now that we've made the lawyers happy, let's begin. Sadly and understandably, many entrepreneurs today have real survival instincts about them. Everyone is quite worried about the future and hoarding in at home and worried about survival. There is a certain herd mentality around this, also understandable, because let's face it, coronavirus is frightening and creates fear amongst all of us. All that being said, for the economy to recover, there will be opportunities, and opportunities will come before each and every one of us and through different doors. And we want to be prepared to tackle these opportunities as they come up. We need to think about what is next and begin to reimagine our businesses. How is COVID going to impact us, and what are we going to become going forward? This is the time to be preparing for battle and to developing our strategy. We need a strategy. Are we going to pivot 5%, 95%, or 50%? We need to decide what our team looks like going forward. And we need to make a plan to get the ammunition for this battle or the cash that we're going to need or want to take advantage of the opportunities as well as protect ourselves. How much cash will be required to get your business back up and running and turn it into what you want it to become again? What is the best case and worst case? Where will this cash come from, and how much are you willing to personally risk? These are the questions I believe everyone needs to think about in the context of Main Street lending. This program has been allocated in the CARES Act for $600 billion. It will be in effect until September 30th, 2020. And it is comprised of 3 facilities: a new, a priority, and an expanded. Eligible lenders will be banks, savings associations, and credit unions, though we do not think this program will be widely available at every bank like the PPP. This will be available on a much more limited basis. Eligible borrowers will have to be established prior to March 13th, 2020. To be eligible, if you have you are not eligible if you have more than 15,000 employees or 2019 annual revenues in excess of $5 billion. And you need to be created or organized in the United States or under the laws of the United States with significant operations in and a majority of your employees based in the United States. You can be a partnership, a limited liability company, a corporation, an association, a trust, cooperative, a joint venture with no more than 49% participation by foreign business entities or a tribal business concern. If you're a developer or a landlord, you're ineligible, and there are certain other industries that are ineligible. Affiliation rules apply. You have to take into consideration when making these evaluations all of the companies that you control or your owners control, and use those numbers for EBITDA, debt, and total revenue and employee calculations. There are primarily, most relevant to most people, are the new and priority facilities, and they share several commonalities. They are secure or unsecured term loans. They have a 4-year maturity. Principal and interest payments are deferred for 1 year. Unpaid interest will be capitalized. They are priced at an adjustable rate of LIBOR 1 or 3 month plus 300 basis points. The minimum loan size is $500,000 and the maximum loan size is $25 million. Prepayment is permitted without penalty and fees are 1 to 2%. The new facility and the priority facilities loans are between $500,000 and $25 million. The key differences between the two are the rights that the lender has. For the new facility, in case of bankruptcy, the new lender must have the same rights as other lenders. But in the normal course of business, the rights do not necessarily matter. And on the new facility, you pay interest only for the first year. You pay nothing during the first year. Interest only during year 2, then a third at the end of year 2, year 3, and year 4. So let's take a new loan facility and row number 3, a company with 2019 EBITDA of $500,000. Well, you calculate how much you could get, it's not to exceed 4x, which is $2 million. But if that company had $1.5 million worth of existing debt, their potential new money could be $500,000. If you take row 1, that same company with $500,000 worth of debt could actually get potential new money of $1.5 million. And the new loan scenario is a company with 125,000 of 2019 EBITDA and 0 debt could borrow $500K. Priority facilities act a little bit differently. In these facilities, the lenders have to have equal or senior rights to any other lenders, except for your mortgage. And the amortization is more favorable to you. At the end of year 2, you pay 15%. At the end of year 3, you pay 15%. At the end of you pay 70%. As an example, in row 3, that same company with $500,000 of EBITDA and $1.5 million worth of existing debt, they were to get a priority facility, they would get $1.5 million. And in row 1, if they had $500,000 of existing debt, they could get a priority facility of $2.5 million. That slide is wrong. It should say a priority loan scenario, but on the priority loan program, a company with $83,000 of 2019 EBITDA and 0 debt could borrow $500K. Expanded facility is a little bit differently. And just to save your brain cells, you need to currently have a minimum of $28.5 million worth of debt to qualify. If you don't, tune out for 60 seconds. This program acts as an extension of your current debt. So if you had, as an example, in row 1, $10 million of EBITDA, the maximum you could get is 6 times that, but that company had $100 million worth of existing debt. 35% of that is $35 million, so that's what they could be eligible for. For all these loans, you cannot use these loans to repay old debt. Those are not an eligible use, and you have to commit to keep your current lines of credit intact. You also have to certify that you have a reasonable basis to believe that your company will not go bankrupt in the next 90 days. You commit to certain capital restriction and stock repurchase requirements. If you're an S corporation, you are able to make distributions for tax purposes. So for those who earn up to 12 months, and while you have the loan and for up to 12 months after you have it, you agree not to pay dividends or make other capital distributions with respect to the common stock of your business. For those who earn between $425,000 and $3 million in 2019, you agree while you have the loan and for 1 year after not to exceed that amount. If you earn more than $3 million, let's say you earn $6 million, you take the difference between 3 and 6, which is 1.5, you add that to the 3, and you agree not to earn more than $4.5 million. You agreed to make reasonable efforts while you have the loan to retain your employees, but this loan is different from the PPP, where the primary goal is to retain your employees. Here, the primary goal is to retain your company. EBITDA will be calculated by the bank if it's a bank you've worked with historically, the same way that bank has treated your EBITDA previously. And if it is not a bank you've worked with historically, the EBITDA will be treated the way that bank has treated EBITDA for similar companies. The debt will include everything existing, outstanding, and undrawn available debt, including unsecured or secured loans from any bank, non-bank financial institution, or private lender, as well as publicly issued bonds or private placement facilities. If you have an asset-based line, it will include the amount drawn against your assets, not the amount that you totally can get. How do you choose a program? If you take road number 3, a company with $6 million with EBITDA and existing debt of $15 million. Under the new program, they could get $9 million, and under the priority, they could get 21, so they can choose which one is best for them. How does this all make sense? Financing strategy is very much offense and defense. Let's go through 3 case studies how different business owners and entrepreneurs are planning on using the Main Street facility. One is a company with a $3 million line of credit and $1 million drawn. The line of credit has a personal guarantee. They are planning on getting an MSLP for liquidity. They would rather not personal guarantee the money they're going to need going forward to reestablish the business. Example number 2 is a professional services firm where the partners expect the draws to be down at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of 1. And example number 3 is a company that has already been approached by several competitors who plan to close shop. They plan to use an MLC to acquire companies at pennies on the dollar, and they want to use the MSLP to help. Again, some things to think about. How much cash will be required to get your business back on a stable footing? What is the best case and worst case? And where will the cash come from, and how much are you willing to personally risk? What does your future look like? What are your plans? What cash will be necessary, and how do you plan to do it? This is the end of my prepared remarks. Multifunding is helping a select group of business owners and entrepreneurs through this program. And now I'll open up the floor to the moderator. I'm happy to take your questions. If people have questions about the PPP or the EIDL, we will try to answer those, but we will take those last. We will start with the Main Street Lending Program questions next.
Thank you, Ali. There are some bank lenders who are close to starting to put borrowers in their system for MSLP. Have you heard of any lenders who are talking to borrowers yet?
We actually have, on a preliminary basis, applications in with a couple of lenders who are reviewing the files and getting ready. They know they don't know the final rules yet, but they are already putting people to underwriting.
And to follow up, is there an estimated date when the MSLP will become available?
I had hoped it would be this week, but I haven't seen it yet. So we're hopeful any day, but we're waiting for the government and we can't predict.
If the principal is making under 300K, can they increase their salary up to 425K?
I don't think there's any issue with that.
Can you please confirm that the MSLP is unsecured?
It is secure. There's no personal guarantee, but it is up to the bank whether the loan will be secured or unsecured against company assets.
Can you say who the banks are that are taking preliminary borrowers?
Unfortunately, that's just for our clients, so no.
Okay, it looks like there are some PPP questions, but I don't see any more MSLP.
Happy to take them if we can help answer.
PPP updated response. As you know, they have changed the rules, and we got the first round of the loan included the FICA, ER, and FUTA in the cost of payroll. Now they're saying we can defer. will not be forgiven. Any suggestions or input?
I really think you have to wait for the forgiveness rules that aren't out yet, but hopefully will be out any day.
Can you explain how SBA's new guidance, FAQ number 46, Safe Harbor for Good Faith Certification, affects PPP loans less than $2 million?
I mean, it's hard for me to comprehend what they did, but they said they're not going to go audit anybody under $2 million. That's what it says. Can they change their minds? They're the government. They can do whatever they want.
Can 100% of the loan be spent on payroll, or does 25% have to be spent on the approved operation expense?
It could absolutely be spent on payroll.
For PPP loan forgiveness, for the 8-week period, should we be focused on payroll costs incurred or payroll costs paid? For example, can we count on payroll run for a few days after the loan was dispersed, even though those payroll costs were incurred prior to the loan? By the same logic, could we move payroll date up by a few dates in order to take advantage of the PPP funds?
I really think you have to run it by however you traditionally do your accounting. If you traditionally work on a cash basis, that's how you should do it. If you traditionally work on an accrual basis, that's how you should do it.
Can the priority loan be used to pay off debt that is not with a bank?
No, but the priority lender has some flexibility to refinance your debt into the loan. And those rules are not clear yet, how that will work.
We are caught up
Also,
on questions.
see, Hannah, there's one question in the chat. I don't know if you saw that. Just want to let you know.
Okay, yes, that was answered. If we'll give a couple minutes or a minute. Oh, here's one. In the Fed term, oh, it's incomplete.
Okay. We're happy to take any other questions, folks.
The beginning of this question says, in the Fed term sheet, it reads, and we are waiting.
Ta-da-ta-da.
In the Fed term sheet, it reads, however, the eligible borrower may, at the time of origination of the eligible loan, refinance existing debt owed to the eligible borrower to a lender that is not the eligible lender. Doesn't that suggest debt repayment?
No, that it suggests if you have debt with another lender, you might be able to refi it with the new lender who's doing your priority. That means you can refi it into the loan. It doesn't mean you can repay it, but that part of the guidance is the most unclear, and one of the things that folks in the lender community and us are waiting for guidance on.
Any idea what costs are included in utilities for the PPP?
I'm sorry, I do not.
So we have to wait for new ruling to know if payroll taxes are forgiven or deferred?
Yeah, I'm not giving any guidance on any of that until I see the new information. I don't consider myself to be an expert on those specifics. You might want to check with your CPA.
Okay, we'll give it a couple more seconds. See any more questions?
While we're waiting, I just want to wish everyone good luck out there. If anyone wants to reach out directly with questions, feel free. And we wish you all God bless and Godspeed. Anything else, Hannah?
That will be all. Thank you so much, Ami.
Thank you, guys. Take care now. Bye-bye.